Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner and adjunct assistant professor at Purdue University. Consider This is brought to you by the Financial Enhancement Group, LLC, where Joe serves as managing partner. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Anderson, with offices in Anderson, Lafayette, Indianapolis, and Rensselaer, Indiana. This show is for educational purposes, and you're strongly encouraged to consult with your financial professionals for personalized guidance. Big Joe can be reached at 800-928-4001. You can find out more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Hello and welcome to Consider This. Joe Clark, Sherry Contos, and others. You are listening to the best of Consider This put together over the last few years of this show. You can find the information from the show on our website at yourlifeafterwork.com, iTunes, and various other places. Obviously, we're here weekly on WILO from 4 to 5 p.m. During drive time, Saturday morning on our flagship station of WQME from 9 to 10 a.m., and Sunday mornings on Shine 99 between 10 and 11 a.m. Consider This really is a show that's much more than just the weekly headlines. We work together to try to give you insights and directions into things that you may want to consider about your financial lives. And the questions come in many directions. You can always reach us on Twitter, hashtag AskBigJoe. And of course, you can email us your questions. Consider This, that's all one word, consider this at yourlifeafterwork.com. We break the show down into what we call 5 critical financial elements. One, always begin with the end in mind. So we start with retirement income. Where is the money going to come from to maintain your standard of living? Number 2, then, is the tax plan that needs to be done each and every year before the end of the year. 3 is the investment policy statement. What's going to keep you from getting caught in a downturned market without paying attention, without having discipline to how you want to respond? 4th is life happens. It's the good and bad and ugly of life, the things that we just normally see that take place. Last but not least is the legacy plan. Everything that we do is all about your life after work. That's the name of our website, yourlifeafterwork.com. We want to take what's going on in the world, keep you abreast of changes that matter. Sure, it's always fun to talk about markets and headlines, but what we really want to do is give you things to consider. So as I said, shoot us an email, consider this at yourlifeafterwork.com. Enjoy the show and keep in touch. We'll be right back.
The definition of insanity is doing the same thing over and over again and hoping for a different result. Without tax planning during the year, that hope strategy simply won't work out. The Financial Enhancement Group can work with your CPA during the year to help minimize taxes in April by working with charitable gifting strategies, Roth conversions, and family transfers. The Financial Enhancement Group can improve your life after work. Call the Financial Enhancement Group at 800-928-4001. They can help you, and they welcome your call.
Monopoly. Remember,
that's what you're thinking about.
That's what's got me.
Why? You've been playing Monopoly like all weekend?
I play Monopoly whenever I can with people who truly enjoy the game.
Okay.
I remember when I was a little boy, we had this little gray safe. It actually had a combination on the front, and I would get whatever little allowance or what money I would make selling grit and newspapers. If you remember those, when somebody knock on your door, I was one of those kids.
5 a.m.
I didn't do it at 5 a.m., but I would knock on doors after school. I delivered the papers and the paper route at 5 a.m. That was true. We had to go to downtown Muncie to pick up the papers to be able to deliver them.
Sure.
Anyhow, I like to count. I would count that money a lot, and I think it truly helped with my math skills.
Sure.
I've watched as I taught at Purdue for 7 years, seniors in Purdue not being able to figure out what 10% of something was. And
I know, because of the phone and computers.
It drove me insane. That how do you have to think what 15% of $1 is?
Yeah.
Or when you go to the restaurant and they give you the tip guide. Here's 10%. If you can't figure out what 10% is and then double it to get to 20,
there's a problem.
Maybe you need to be in school and not eating out. Just saying. Anyhow, so Monopoly was one of those things that I think teaches kids how to understand value, right? Because you got to know whether you're buying a house or whether you're buying a hotel, whether you should buy that property, what that property is truly worth to you.
The potential upside of that property and the downside.
Understanding value is an important thing, and being able to use currency, though it was funny looking currency, being able to use, the $500 or the $50 or even the little dollar bills, being able to use those to understand, this is the value that you're trading. This is the currency that you're trading to get this back. I think is a very important educational lesson.
Yes.
Okay. But Monopoly just went electronic. So now there's no banker. There's no banker position. Everybody has essentially an ATM card. And when you decide you want to buy the hotel, you insert your card and it will deduct for you or keep track of the amount of money that you have.
For real?
This is for real.
For real?
For real.
If I go to a store and I buy a box game and it says Monopoly,
you may still have an option to be able to do both for a while. But yes, the banker position has been eliminated. You're now going to use the ATM card. And I have an issue with that.
I do too, because how is someone supposed to understand where it's like, what is that? Is that like a magic fairy, the ATM? I mean, it's not, you know what I mean? It's kind of like people go to a bank machine.
I remember when we first started having the machines, the ATMs where we could pull currency out.
Yeah.
That people thought Americans really could just push buttons and get money in foreign countries when they saw that happening. So it really was a cultural problem. But I never thought about watching Monopoly change. And one of the things that we do for the families that we take care of, for their grandkids and their children, we send out academic or financial academic games each year.
Seriously?
So they get a birthday card or something like that with a little present. But 6 months after that, we send them out something for people that are essentially ages 4, to 8, then 8, or 9 to 12. So there's 4 different sets, and the letter goes to the parents and says, here's a game that you can play with your kids to try to teach them things. And I've not added Monopoly because I didn't think you needed. Monopoly was doing a fine job on its own. I may have to pick up the Monopoly thing, but we're actually doing something this in the summer with the Indianapolis Indians, where we're having a grandparents camp.
Aww.
And part of that is where the grandparent can bring in their kids, and we're going to play a financial game to try to teach kids how to invest better and understand what happens. And you've got to be thinking about this, folks. We all have heirs. We all have beneficiaries. It may be your goal to hand the mortician the last dollar when they're getting ready to close the coffin. It just doesn't work because we don't know when God is going to call us home. We just do not have that ability. So somebody is going to get what you have saved and accumulated. My opinion, I would rather them know how to handle money while I'm alive, so that I can fix it when I'm still here, as opposed to give them a large sum of money, hopefully at the end that they don't know what they're doing with.
Well, and think how you're setting them up for life, because so few people your grandkids' age are going to know how to handle money. If you teach them, they're going to be like way ahead.
We are going to play Monopoly at the Clark household. Next one's from John Lambert. John is a manager with GAM. Says, compared to most professions, investors suffer a distinct lack of useful information and feedback that would enable them to improve their process and ultimately their results.
Now, see, I'm shocked by that statement.
I know you are.
I am shocked. I would think investors of all people would have access to all the information and anything they need. I would think they would have.
Sherry, we all live with things that are called biases, cognitive biases.
Okay.
And if you ask somebody who has never been divorced if divorce is more common than marriage, they will tell you no. Yes. If you ask somebody who's been divorced, they'll say, well, yes, divorce happens. It's one of those things. You golf, not a lot, but
I would not ever call myself a golfer, but I have been on the course.
So let me give you a thing. One of the things that you will often hear stated on the golf course is that you drive for dough, or you drive for show, you putt for dough, meaning the best putter wins. Right? Yeah. And the drive is just for show.
Right. Okay.
The problem with that statement is it's not right.
Okay.
Right. There's a little book, if you're a golfer, you ought to read, called Every Stroke Counts. And it's written by the guy who came up with the terminology strokes gained. And what we found out is where that drive is, where it lands, directly gives you the greatest ability to have quote unquote strokes gained. You make a 3-foot putt, that's not any strokes gained. Everybody can make a 3-foot putt.
Yeah.
Right. It's when you get further and further out that the gains really, really matter. Most of the growth, a 10 to 20 handicapper, is really going to be on making sure that drive is in the fairway with as much distance as it possibly can.
Yeah.
So when you look at the stuff that we do, we have an allocation meeting every week. Mm-hmm. It's dedicated. It's as far as we know, it's still the only allocation meeting where families are invited to attend. Mm-hmm. You have to get a reservation. You can't show up one day and say, I'm here. But I've never had anybody come more than twice. Most people really don't want to know how the sausage is made, right? Especially the ones that we take care of. But we sit down and we have that team allocation meeting every week. Mm-hmm. We run 6 different models. And
can you explain, because I don't think most people would understand, when you say allocation meeting, what does that mean?
Well, we have $220+ million that it's our responsibility, a little over 600 families now. It's our responsibility to help them understand where their money ought to be in. So when somebody comes in, we help them develop that family vision. I don't pick up a phone and call you and ask you what you think about Starbucks business model.
So one of your families just kind of signs off and says, I trust you, Joe, even though, I can come and see your allocation meeting if I want to, but I don't want you calling me every single time you need to make a change.
Won't call every single time.
Right.
Can't call.
I can't. So you have authority to do that.
Regardless of who you are listening to the show, you will not be my biggest account, most likely. Yeah, right. And you would not be my smallest, most likely. Still have a lady from our church that I've taken care of for many, many years. It's got a little bit less than $50,000. Mm-hmm. The majority are between $2 and $1.2 million, but we've got some really big ones that are out there as well. And we really enjoy helping everybody with that. But that's not the point. The point is when we have that allocation meeting. And you've got the all equity, the growth, the balanced, the conservative, the capital preservation, and hedge depreciation are the models that we run, and then a tax efficient model and a tactical edge. Those are the models that we have. So what we're doing in that allocation meeting is sitting down and we're examining ourselves, because it's not my job to hold a company today that did something well for me a year ago.
Right.
Now I have to take into consideration the tax impact. Right.
Oh yeah.
Can't forget that part. Right. But in an IRA, there is no tax impact. So merely holding on a company today, and I'm not talking about just price, right? And I'm not talking about just price, material changes, something that is either improved or harmed a company. Right. Price clearly matters.
Right. Oh,
but price alone is not what dictates the decision that we have to make.
So when you say, back to the allocation meeting, what you're really going to do is look at all the companies that you currently own or might own or have.
Yeah, we have a farm team. Those are the ones that when more money comes in or the time is right that we put capital into. Yeah. So we're studying companies, not just ones that we own.
Exactly.
But yeah, we look at everything that's in the portfolio consistently.
And how often do you do this?
Well, daily. Adam is a CFA. That's what he does. Right. Andrew's the chartered market technician. That's what he does.
Yep.
I'm the macroeconomist. Unfortunately, macroeconomics doesn't change much from day to day. Not even week to week.
No, but it's very interesting.
It is very. It's very interesting, but it's the important part is the geopolitical changes that are going on.
Yeah.
What's happening with some of those deals. We bring all of that data together and we decide if something needs to be added to, reduced, trimmed. One thing that's very different about a professional money manager than most of you that are listening to the show, when we buy something, rarely do we buy a full position. When we sell it, rarely do we sell it all at one time. Yeah. That's just not the way that it works, which by definition, if you really want to be a negative Nelly, we're always wrong. Right?
Yeah.
You either sold half of something that still went up and people go, what are you thinking?
Yeah.
Or you sold half of something that went down and said, you knew it was going to go down. Why didn't you sell it all?
Exactly.
Right? And the answer is we manage risk. That's our job. And it's to make sure that people are able to maintain that standard of living to which they have become accustomed.
Leaving a legacy is more than just leaving behind assets. It's leaving memories, values, and life lessons. The Financial Enhancement Group helps families work with their attorneys and their heirs to make sure everyone is on the same page and that your goals are being met. Communication, clarity, and attention to tax code changes are the keys to truly passing on what matters most. The Financial Enhancement Group can help make your wishes come first. Call the Financial Enhancement Group at 800-928-4001. They can help, and they welcome your call.
All right, we got time for one more.
Okay.
Mariko Gordon is the Chief Investment Officer at Drama Capital Management, and he said it's very important not to be prejudiced and stubborn. You have to be open-minded, but you also have to be very disciplined and grounded and firm, too. So it almost sounds a little contradictory,
Yes.
but I got called on this, and very, very valuable lesson. You do this for 28 years, and things are going to happen. You know, I'm a very, it's, they say there's three things you don't talk about in Indiana, right? Religion, money, and politics.
Yes.
Well, everybody who's listened to the show or my students at Purdue know I'm a Christian conservative who manages money. So now that we got
are a lightning rod.
Now that we got that out of the way, I'm one of those bad guys, right?
Yeah.
Now that we got that out of the way, seriously though, the issue is knowing what my biases are. And I have a lot of friends that didn't do so well under the George Bush administration when he made dividends a more tax efficient instrument. Back in March of 2003, their tax code change came down, the market went rocketing, and some of my friends in New York hated the Bush so much that they refused to understand the value of what was going to be there. Fast forward, I had a lot of friends that really had no use for the current president, in the first term, let alone 7 years later,
right.
And could not see how there could be any possible way that the market could do well, and obviously 2008, first part of 2009, it clearly wasn't. And then because of all of the QE and everything else, the market rocketed its way up. You have to remove your biases and your stubbornness. There's an old expression, it's okay to be wrong, you just don't want to be wrong long, right? So when things change, you have to be willing to change. And that doesn't mean you change your morals or give up on your principles. There's just some things that you've got to be rigid about. One of ours is, again, counting irregularities. We're just not going to go there. IPOs, initial public offerings that come out, people will say, hey, are we going to be able to get into that? Should we get into that? Honestly, we don't want that kind of excitement. Look at the IPOs from last year, Alibaba, and where it was and how far it fell. Even Facebook, which now would have wound up being a wonderful thing, but Facebook got cut by a monster amount, after it went public on its original drop. We want to be able to have data, information, be able to access that, and to be able to run that through that proprietary risk barometer that we have that says, okay, it's time to be on offense. It's time to be neutral, or it's time to be on defense, and make sure that our money is going in the right direction. Hey, there are a lot of things that go on in the investment world that people can get right and can get wrong. One of a great book to read if you like it is Liar's Poker. Nicholas Taleb is probably better known for, he didn't write Liar's Poker, but Liar's Poker is a great book to understand what goes on in some of the bond markets and things that are going on.
Liar's Poker.
Liar's Poker.
Okay.
Explain what happened to the home loan savings, and very, very similar to other stuff that's going on. But Nicholas Taleb wrote a book, essentially the one that everybody knows about is The Black Swan. But it talks about people who get in trouble by having one-hit wonders on Wall Street. When he was a trader, he would bet against the guy whoever did the best the last time he would bet against every time.
Really?
Yeah, and it's because it's the only way you could ever be the best on Wall Street is to have all of your eggs in one place.
Oh,
and when that hits, you get very, very lucky, but it's not going to hit very often.
Right.
And you can get into trouble. Even Bill Miller, who has been a famous money manager for a long time, has gotten himself into mischief, by not being very well diversified, making big bets that sometimes worked and sometimes didn't. What we're going to do is go through a bunch of different different professional money managers and just talk about some of their theories. They were essentially asked, what is the biggest mistake that you see investors make? And then they've got their answers and their logic. So this one was from Howard Marks. Howard's one of Adam and I's favorite people to listen to. He has taught us a lot. He's the co-chairman of Oak Tree Capital Management. And he says people get into trouble in investing when they have unrealistic expectations, especially when they have the expectation that higher returns can be earned without an increase of risk.
Yeah.
So that's it on how. Did you have something, Sherry?
No,
Okay.
We've talked about risk in the last segment. Yeah.
So let's talk real quickly about what risk means, and it's one of my challenges, I think, in trying to help people understand their money better. Prior to the fireside chats, so you're going back to FDR days. Mm-hmm. Prior to the fireside chats, stocks were not considered risky.
That's interesting.
What? Tell me something when you hear the word risk, Sherry, that sounds positive to you.
Nothing.
Can stocks go up?
Yes.
So is that risky?
Well, no. I mean, and that's what we got at the last segment. So in anything, I think if the potential benefit is great, so is the potential loss in anything.
Fair enough. But the word risk in our human mind will only give us a negative influence.
Right.
And in our case, in the investment world, risk truly does mean volatility.
Yeah.
It does not mean loss of principal. It means volatility.
And doesn't it also mean potential? Like potential potential.
That's why stocks were referred to as speculative. Right? And it was speculative. You're going to speculate on a company that their management's going to continue to do well, products are going to do well, locations are going to do well. Mm-hmm. You're going to speculate, and that speculation could be good or it could be bad. And the better you are at making good decisions, the better speculator you are.
True, but why then were they not considered risky prior to the fireside chats?
Because we didn't use the word risk, because risk is only negative in the human mind.
So what did we use?
We used the word speculate. Stocks were considered speculative. If you go read Jesse Livermore's the Almanac of a Trader, from the early 1900s, they talk about the speculation and the volatility that goes on with it. FDR needed the money put back in the banks, and so he changed the word. Either he or his speechwriter changed the word to risk, right? So that people would put money back in the bank, not necessarily into the market. We forget there were 2 weeks where the banks were shut down in the Great Depression, right? And that led to a lot of challenges. So what Mr. Marks was saying about not understanding that increased expectations require increased risk, he used the current terminology that we have, but what that means is more volatility. Mm-hmm. Historically, when you buy an equity, you buy a stock, the amount of volatility over a 1 year period of time is the greatest, and over an extended period of time, you have less of volatility. So you may have an expected rate of return of, let's say, 10%, but it could be 22 or it could be negative 18. And we wouldn't necessarily refer to that as risky over that 1 year, right? Because that's in that's the normal possibilities, the normal realm of what could happen. Anything greater or more or less than that would be a different story. Over a 10-year period of time, you may still have an expected rate of return of 10 or 12%, whatever it is, but the range is going to have dropped from maybe positive 14 to a positive 4, right? With bonds or fixed income, you tend to have on an annual basis less volatility. So if you had an expected return of 4, maybe you got 5, maybe you got 3, but rarely would you see anywhere near the drop that you've seen in an equity market or could see. That's why when we talked about the dollar cost averaging, it doesn't work with bonds, does work with stocks, right?
Yeah.
You actually count on that volatility inside of the accumulation phase.
And people think they can manage the volatility, but by definition, you can't.
You have to. What you have to have, and we'll get into that in some of these other comments. What you have to have is the discipline to be able to manage your own emotions through the volatility.
Right.
You can't control when a market is going to be more volatile and not. There are articles that are written when I do my research, either for the radio or for teaching the planning team. sharing with them. We do a couple of unique things, I think, inside of our office. One is because we manage the money internally, we have an allocation meeting that we have every week. Where we bring in people so that they can listen to what's going on. If you're a family that we happen to serve, you're actually welcome to attend with a reservation the allocation meeting. In all the years I've done it, I've never had anybody come more than twice. Mm-hmm. Most people just don't want to know how the sausage is made.
So when you say allocation meeting, I'm not sure people know what that means.
Well, we have a little more than 600 families we take care of. And there is about 7 or 8 different investment models that we operate. Mm-hmm. So if you come in and you've got money that's after tax, that's in an account that's exposed to the IRS, we're not going to liquidate everything that's in that and just put you in front of an IRA, the IRS's harm's way.
Sure.
We're just not going to do it. So your portfolio may look a little different from a tax perspective.
Right.
But in an IRA or a plan like that, the models all look the same. So if I'm imbalanced, you're imbalanced, we're going to own the same percentage of the value. The account size may be different.
Right.
But we're going to own the same thing.
Right.
Our job in that allocation meeting is to be able to sit down and to make sure that we have the right things in each of those models for what they're assigned to do for their.
So you're going to talk about
task.
Specific companies,
individual companies, and individual exchange traded funds, and the macro things that are going on.
Right. Yeah.
Adam is our fundamental. He's a CFA, the chief investment strategist, and his job is really the fundamental part of the overall market, as well as the sectors, and then the individual companies that we have. He looks at them on a fundamental basis.
Yeah.
Andrew is a chartered market technician. His job is to look at it from that, what's the stock doing price wise compared to it's the same sector, same peers. And I'm more of the macroeconomics. What is the big picture and demographics, in the world as we live in today, telling us that we need to be paying attention to?
See, I think I would like this allocation.
It's fun in our minds, but like I said, nobody's come more than twice. But the other thing we do is have a planning meeting, and the planning meeting is where we bring in the financial planners and 2 of our senior paraplanners. They come in and we talk about everybody we saw the last 2 weeks because everybody's on salary. There's nobody gets paid to do anything.
That's
cool.
So
it's Sherry would say, okay, we saw these people and talked about the Social Security, and everybody would make sure that we would have said it the same way or add any thoughts that need to be able to be in.
That's a good idea.
No different than the medical world that does it when a patient's died.
Yeah.
They have a debriefing over what could we have done better, differently. We do it up front to make sure that everybody stays on that same page. And if it's something that we've never come across, we build a one-page a checklist that says these are the things that you need to ask to know, so that when we bring in a new planner or a paraplanner is doing it, we have the ability to be able to get that done. So anyhow, in this case, it's an oddity. The title of the article came from Money, and the title of the article was "Couples Get Separation Anxiety Over Financial Planners," and it was re-aired in Reuters. And he said that the 13%, according to the study, this is actually done by Fidelity, 13% of couples keep their own respective financial advisors, according to a 2015 couples retirement study from Fidelity. And I first thought, I said, there's no way. Well, we're kind of weird at the Financial Enhancement Group. 600 families, and I think there have been 28 divorces in the whole thing. They're long-term marriages. Almost everybody is married or widowed or widower, and just the way it is. But we do have people who have come to us after a second marriage.
Yep.
Who have me as a planner on one side, and they do their own 401k. They may not have a planner. They may think they can do it on their own.
Yeah.
And there's one family I mentioned that I actually take care of both of them, but separately.
That's so funny.
And so in their research, they said 28% of couples reported keeping their financial accounts mostly or completely separate from their spouse or significant other. That was up from 20% who did that just 2 years earlier. Most of it is the Gen Xers that, according to the study, that probably shouldn't be surprising. They said that was because people were getting married later.
Right.
Often had careers, already established a relationship.
Right.
The average woman now, which has increased, because we used to get married at 25 and a half. Average woman's getting married at 27. Average man's at 29, both historic highs. The problem here, guys, is it's very easy to have conflicting strategies, overlapping holdings, and duplication of fees. And we all know that I hate excess fees and expenses.
Yeah.
The duplication of strategies is one thing. Overlapping are things that are contrary, bug the garbage out of me. But the real thing is, if you are married and you're filing a 1040 jointly. And again, this article did not take into any consideration what's going on in that tax return. Whether you're doing Roth conversions or not. If Barb and I kept our money separate and I did something that impacted her tax return, she's going to have to pay the piper, even though there was no way to have that discussion.
Right.
And I think the article goes through this thing of life saying, hey, we need to continue to we need to communicate. We need to talk about the investment. I'm going to give you some of the things they said, which some of them, it's obviously he's never dealt with people. But it's still the 1040 has to be the thing that is there. So his first suggestion is get the planners in a room quarterly or at least annually. So you'd have me and the hubby and you and the wife, and we'll just have a sit down. Brilliant. Yeah. Talk about more fees and expenses in an agitated situation.
Right.
This is if you've ever done anything in mediation or anything else, because either one of the planners, if they were doing their job as I do with the ones that I take care of individually, I have told them on multiple cases they would not hurt my feelings. It would be better for you to have one person working together than for what you're doing. And they say, well, I'm not leaving you and my husband won't do the other. Or, my wife won't do the other. And it's, it is what it is, but, you just can't. Secondly, don't feel pressured into snap decisions. You should never feel that. Unpack your attachment. Ask why this planner is better than that planner or this company is better than that company. That one's a good one. Use the moment to uncover savings. Now, this one is good. In this suggestion, they said maybe one partner has very favorable fees with a particular bank or brokerage firm, while the other has a terrific deal with an insurer. And that happens especially in company benefits. I see that a lot where one 401k plan trumps another 401k plan, or where the matching is different. We really want to be able to bring those all in together. And the example that they used in here, they had 14 different financial accounts scattered among various institutions. 14. How do you keep track of that?
Wow.
You can't give any of them the time that you need. People do that out of thinking they're having diversification, and that's just not, it doesn't work well. But, we want to pay attention to old annuity contracts, things that are out there that give you better strength and opportunities. And it's, you need to know, even if it's a second marriage, even if you were late getting married, let's look at what all of the advantages are. Even if you're going to keep a checking account separate, let's at least know what's going on, because it all winds up on your 1040. And my friends, it's all important. When markets go up and down, savings accounts go up and down. When you send a check to the IRS, it never comes back. It just doesn't. And if we can keep that 1040 in front of us at all times, make the best decisions there, we'll have a better chance of helping you get to retirement and enjoying the life that you've so desired. Hey, you're listening to Consider This. I'm Joe Clark, along with Sherry Contos. You got a question or comment? Shoot me an email. Consider this at yourlifeafterwork.com. Got to take a break. We'll be right back.
Leaving a legacy is more than just leaving behind assets. It's leaving memories, values, and life lessons. The Financial Enhancement Group helps families work with their attorneys and their heirs to make sure everyone is on the same page and that your goals are being met. Communication, clarity, and attention to tax code changes are the keys to truly passing on what matters most. The Financial Enhancement Group can help make your wishes come first. Call the Financial Enhancement Group at 800-928-4001. They can help, and they welcome your call.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
Happy to have you along. You are the most important part of the show, by the way. In the Where's the Beef, the big question that we always run across is, when should you start Social Security and when should you begin to taking IRA and 401k withdrawals? Right? In distribution, you're landing the plane. Now you have to take income. Right?
Yeah.
You where's the beef, right?
Right.
You've got to be able to eat. And so that dollar that actually, when you go to take the dollar, remember in distribution, your two goals, right? Remember what they are, Sherry? What are the two things that matter in distribution?
Not average rate of return.
Not average rate of return. That's correct. There's volatility between distributions,
yes.
Right? Volatility between distributions, not average return. And then the second one is, how much tax do you pay on each dollar that you withdraw?
So where you're taking it from.
So where you're taking it from
matters. Yeah.
So it's Social Security. You're going to be eligible for Social Security at age 62 if you take an early benefit, right?
Right.
If not, it's 67.
Right.
Okay. And over 70% of America, the Social Security Administration says, takes it at 62.
Interesting.
And it's because they don't perceive it. You come up with all of these justifications, right? What if I die? What if the government goes broke? What if if you quit sending it?
And it's there.
People will come up with all of this of these almost paranoia beliefs.
Yeah, right.
So the way Social Security works, if you've listened to the show before, every dollar that you put in, you actually get an 8%. Every dollar that you leave in, you get an 8% increase each year, or an 8% decrease, I should say, if you take it out early. Yeah. For each year you took it out early.
Wow.
And you can let it grow all the way to age 70, where it continues to grow by 8% a year. So a retiree, just to give you an idea, when you look at it, could get $1,500 a month as a benefit at age 62, or could get $2,640 if you waited to age 70, right? So you give up $144,000 of income now.
Yeah. Right.
But in 10 and a half years, you've recouped all of that. And that doesn't count the cost of living adjustments that take place on side of this.
Yeah.
Right. So when we talk about risk and volatility, the risk that most people deal with is the risk that's in the market. And in all fairness, it's, if I put $1 in, Joe, do I get $1 back? Right? It's risk of principal. That's where our heads always go. And that's why we get Social Security kind of messed up. Yeah.
This is a very specific Social Security question. Do we have time for me to ask it?
Go ahead.
Okay. So if you said if you take Social Security 62, it decreases by 8% per year early that you take it. Now, what happens if you're the spouse and you're going to, because it works out this way, take your spouse's, your husband's or ex-husband's Social Security benefit? What if he takes it at 62 and you don't?
As long as you were married 10 years or longer, what he does doesn't matter.
Doesn't matter.
You still have the ability to file based on whichever one is.
But that amount.
But that amount is going to be reduced.
No. But I mean, if let's say he decides to have his,
he's out of it.
He's out of it. Okay, so you start with a number.
So if you start with a number. If his benefit was $1,500 and you're entitled to half of his,
right?
If you take your half at 62. You're going to get a lower benefit than you're going to get.
But what if he takes his half?
His has nothing to do with it, Sherry. This is easy. He has nothing to do with it.
So that's
he's an imaginary person now.
Okay, so that $750 per month
is going to be reduced
if you take it at 62. Won't be if you wait to 67.
Correct, and would be actually increased if you waited all the way to 70.
Got it.
Right. So he has nothing to do with this any longer. So that's the thing that we used to, when you talked about some of these applications and, filing the restricted application. So I would file and suspend. That's what Barb and I
yeah.
Can't do that anymore.
Can't do that anymore.
Right?
So now none of that matters.
No, some of it still matters. It's not that Social Security planning is out the door. As Mary Beth Franklin, a friend of mine who writes extensively about this, would tell you, it's not that it's out the door. It's just some avenues have been changed, in terms of what it is you're capable of being able to do, at this point in time. Right.
Okay.
And you just got to be able to go and look at it. And again, this show comes out of Anderson, Indiana. I will tell you, we've got some of the top Social Security people at the Social Security Administration here. They really do a good job relative to other communities that we've seen.
Yeah, because you said they were aware of all these.
Yeah, they've been very, very, very good at that stuff, and I appreciate it. So again, with the fiduciary focus, 4 things: risk and volatility. That has nothing to do with your Social Security, other than the money that you have inside of your IRA or your 401k is going to continue to grow or go down depending on how the markets are doing at the time.
Right.
Fees and expenses. Taking money out of Social Security is not necessarily a fee, right? However, your income is going to be adjusted by 8% per year, whether you choose to take it early or you let it delay or grow. Taxes, this is a big part of the deal, right? And it's one of those things when we get into the conversation of a 401k that we're going to be able to cover. But in essentially in 1978 is when the 401k plan was accidentally created. First guy actually did it in 1980, right? First company that actually did it. And in 1980, when we talk about marginal tax rates, the top rate was truly 70%. That's what the top rate was when Reagan took office. Today, that top rate's 39.6.
Yeah.
Right?
Yeah.
So Reagan changed the tax code in 1986 to 15, 28, and 31%, 31 being the top, right? So in many cases, I think people made elections inside of the 401k without really thinking about the tax implication and the option. Here's one thing for you to keep about, because remember, our job as your financial planner, as your fiduciary, one of our jobs is to make sure that you pay the least amount of taxes on every dollar that you spend.
Right.
That's the job. Maximize
Makes
brackets,
sense.
minimize the amount of money that the IRS gets. So the formula for taxation of Social Security counts a dollar of pre-tax traditional distributions as one. Now, let me give you a little background on this, Sherry. No more than 85% of your Social Security income is taxable at the federal level.
No more than
Undercurrent.
85%.
So if you get
Okay.
1,000, 850 of it can be taxable. It's taxed based on how much other income you have.
Okay.
Right?
The Social Security money has already been taxed.
That's why you don't pay Social Security tax on it.
Okay.
Right.
All right.
That's why you don't pay it. So you still pay federal tax on it.
Yeah,
Up to
yeah.
85% of it is taxable
Oh, okay.
based on what your other income is.
Okay.
Money you have inside of IRAs and 401ks is when you turn 70 and a half, you have to begin to take money out in most situations. Those are called
Right.
required minimum distributions. So every time that I put a dollar of IRA income on your tax return, the Social Security Administration counts it as a full dollar. On the other hand, when they look at a dollar of Social Security, it's looked at as 50 cents inside of the formula to determine how much taxes are going. So by delaying Social Security, increasing your IRA distributions earlier on, you can truly save a lower amount of taxes over time. When to take Social Security is a big question. It's an independent decision. There's 23 different things that we look at,
Wow.
to try to help people make the election. It's how are you going to invest money? Do you need the income? How's your health? A whole slew, if you will, of questions, and they're conversations that are just worthy of having.
Yep.
Now you ask about taking that Social Security, and I do want to make sure you understand he has to be at full retirement age. So
Right.
It
Yeah.
depends on your age before you have the ability to go do that. Just to keep things square and up front. If you're new to consider this, I really don't talk about the headlines a lot. You have not heard me talk about the Brexit, the vote that's going to go on in London and what that means for the economy. I really don't even get into the economic stuff that is happening, and that's
Or politics. We don't talk about that either.
That's not because they don't matter. Every week I send out something on a video newsletter we call the Market Carver. It's free to anybody who wants it. After we do our allocation meeting on Monday, there's 18 of us that are on our team, and 3 of us are directly responsible for the portfolios. So we manage a little more than $200 million, and we come together every week. We're obviously working on it all day long, every day, but we come together every Monday and discuss everything that's going on in a collective setting, distribute that information to the team, make the changes that need to be made when they need to be made. And then Adam Harder, our Chief Investment Officer and Chief Investment Strategist, I should say, in a CFA, one of the two of us do a video called the Market Carver. It comes out. It's free for you to be able to get. That's where we talk about the NIBOR and unemployment rates and the Brexit and all of that. Interesting stuff that is going on. I want to move to an article. I read a lot, obviously. I used to teach at Purdue, and I taught financial planning there for 7 years, 14 semesters, as I like to say, because each class was different. And I would walk people through the various things that I have learned in 28 years of being a financial planner, and tried to teach and impart that knowledge onto those kids. The 4 things that I find that are the most important in helping people understand their money, and we call it in here the fiduciary focus. Remember, as a fiduciary, my job, Sherry, is to treat your money as if it were my money and we were in the same situation.
Right.
So I have to look at your age, your income, your objectives, your tax rate, and then do for you
what you would do,
what I would do for me if we were in the same situation. We don't sell things, so it's not my job to say here's 3 insurance policies, or here's 3 annuities, or here's 3 mutual funds. Which would you prefer?
Wow.
Right? That's suitability.
Yeah.
My job is to say, okay, based on the data you've given me, Sherry, this is what we're going to do for you.
Okay.
Right? So just like a doctor, if you don't give me all of the information, I can accidentally hurt you. You got to tell me everything that pains you.
Right.
And then we're able to go in and do the things. Well, the fiduciary focus is made up of 4 things. And if you, in my opinion, do not pay attention to each and every one of the 4, you will wind up with less of a retirement than what you probably wanted.
Okay.
The first one is risk and volatility. It's understanding the movement of the markets and being able to have something that, from a temperament standpoint, you can maintain that perspective, that standard, if you will. The second is dealing with fees and expenses. Both are very important, and understand they are different. Expenses are what are known. Fees oftentimes are trading costs and things like that are added into the deal on the way. The third is taxes, but it's both today and tomorrow. We're going to talk in the show about the advent of the 401k and why I think people truly missed a lot along the way. And you just need to be aware of that. But the taxes both today and tomorrow, it's how it impacts your return while you're working, how investing impacts your taxes when you're on Social Security, etc. Last but not least is making sure that you get a real return. Now, real means something above zero plus whatever the inflation rate is. It doesn't. If you think back into the 80s where we saw 14, 15, 16% inflation, the purchasing power of your dollar can go down very, very quickly. Today, there are many people who argue we're in a very low inflationary environment. I would beg to differ. We're in a very low inflation environment for goods. TVs are cheaper. Computers are cheaper. Things are cheaper. Services, on the other hand, are more expensive.
Yeah.
And if you're buying into this notion that inflation is cheaper, or if inflation is low and keeping money in a bank at 0% or at even 1%, you're not getting a real return. And so that fiduciary focus means we've got to bring those four things together. We've got to look at the risk and volatility, the fees and expenses, the taxes today and tomorrow, and the real return. So there was an article that came out from, it's on Wall Street, what it's called, and it's written by, or the quotations come from a guy named John Bogle. Now, you may not know his name. John's the man who built Vanguard. Vanguard is known for the cheapest solution, if you will, for mutual funds and now exchange-traded funds.
Cheapest solution.
It's all a bit about fees. How do we make the fee the lowest amount we can?
I see.
Bogle was the genius. Not that he should have done this, but he was the genius that created the notion of having an S&P 500 fund. He's the one that really built that and turned himself into a billionaire in doing it. So the headline of the article is, Bogle says cost can cut returns by 66% over time. And 66, 2/3 goes to cost. That is not true when you have a fiduciary who's minding the shop, right? That is true in many cases when we see these very expensive mutual funds. That's why the Department of Labor rule has come out again, the 401ks. But he calls it the tyranny of compounding cost. And the example that he used, he said, let's assume a stock market gives a 7% return over 50 years. If you get 7% each year, that dollar goes up to $30. If you drop it to 5, that would be 7 less the 2% that the average industry charges. At the end of 50 years, you only have 10. So it's $10 for you or $30 for you. Which would you prefer, right? and that's the way that Bogle puts it. Now, again, if you're in a relationship where all that they're doing is doing the investing for you, and they're charging you 1% or 2% to manage money, and they're putting it into products that have more charges on top of it, which is what I call wrap accounts. And they're very, very problematic, very, very expensive, then I would concur, you've got a problem. When we sit down with people and help them manage their money, we charge a fee as well. But we're also going over that tax return. We're working on the retirement plan. We're working on their investment playbook, helping them with the things that go on through life, and also helping them figure out their estate planning, how to leave stuff behind to their heirs and to their children. So you can't just look at it as an investment alone. That's why I said it's those four things. Risk and volatility do matter. They do matter greatly. But fees and expenses matter too, as does the taxes. We had a young family that emailed me on Monday morning and said, "Hey, Joe, we inherited a little bit of money. We put money inside of our Roth IRAs. We've got about $20,000 left that we want to start building an investment account. Will you or one of your guys help us?" And we always help the younger generation. It's part of the deal. And so we said, sure. What they didn't understand was that the money that they put inside of the Roth, they still have access to if they needed an emergency. So yes, building an outside brokerage account works, but as much as you can put into that Roth IRA on a contribution side, they really ought to be doing. So don't just get blinded by fees and expenses.
Yes.
Pay attention to risk and volatility,
Yep.
and especially taxes today and tomorrow, and of course, the real return.
Buying investments can be fun and exciting, but selling them is almost always painful. You either have to recognize a mistake or pay taxes on a gain, and neither is pleasant. If you're tired of worrying about your money, consider calling the Financial Enhancement Group at 800-928-4001. They're registered investment advisors, and they'll help you not only document your investment strategy, but also oversee the tough choices and decisions. Call the Financial Enhancement Group at 800-928-4001. They're here to help.
We're very honored that you're taking time out of your day to join us, whether you're listening on one of the multiple stations that airs across central Indiana, iTunes, or you found us on our website at yourlifeafterwork.com. We are here for you. I hope to give you plenty of good things to think about today.
Yes.
And tomorrow. Things that you need to consider.
Yes.
Hence the name of the show. So, hey, if you're new to the show, we appreciate you tuning in. I do my best not to talk about the headlines that are going on in the world, but try to give people a better understanding of their money from a certified financial planner standpoint, an educator standpoint, and just for doing this for a long time. I recognize that not everybody is listening to the show. Is going to come in and say, Joe, help me. I fully understand that. Yeah. I still want you to have a better understanding of your money, regardless of where you are or what is going on inside of your life. The world of finance is very, very, very complex, and I think that we try to make it appear simpler so that we can justify decisions that we make. You spend a lot of time and energy making money to save for your retirement. You sacrifice anytime you save money. You're sacrificing something that you could have done today. What I want you to get out of this show is the best understanding of where those sacrifices need to be made and how to get the biggest bang for your buck. If you do not understand your money, if you do not understand your tax return, eventually bad things will happen.
Well, yeah. And can I just say, it's not just about that. It's about all the rules and regulations and things that change on a daily basis that
just make Sherry so happy.
That make me crazy that you wouldn't know. The average person wouldn't know.
Well,
just saying.
And it is a little more complicated, but it's a wonderful world. Love what we get to do, and I enjoy being able to do this show. If you've got a question or comment, something that you would like to hear Sherry and I discuss and break down for you, more than happy to do that. Just shoot me an email. Consider this at yourlifeafterwork.com.
The Financial Enhancement Group can work with your CPA during the year to help minimize taxes in April by working with charitable gifting strategies, Roth conversions, and family transfers. The Financial Enhancement Group can improve your life after work. Call the Financial Enhancement Group at 800-928-4001. They can help you, and they welcome your call.
And Sherry, based on your eyeballs,
yeah.
eyebrows,
yes,
period.
Yes,
I take it you do know who Phil Mickelson is.
I do, yes,
but you have no idea what happened.
I have no idea what happened. Right. No, I have no idea.
There's others that may need a little bit of a backdrop. We're not going to spend a lot of time on this. I promise.
Not everyone's a golfer, Joe. I just want to say,
ought to be a golfer. It's a great sport. Mark, Samuel Clemens, i.e., Mark Twain, was a smart gentleman, but it's not a good walk spoiled. It's a great time to be able to spend with friends and family. That's another story.
Okay.
Mr. Mickelson,
yes.
Best known for the flop shot.
The flop shot.
Yeah, he puts the ball very high in the air and lands it very, very softly with wedges. That's his earmark thing. Even can hit it backwards and do that.
Wow.
It's very kind of fun. But it turns out that he likes to play poker. And was allegedly playing poker with a famous poker player who gave him an insider scoop on Dean Foods. So when you have insider knowledge, you're not allowed to make any trades buying or selling based on that. We've seen Martha Stewart go to prison over this. It's a big deal. Well, in this case, a lot of the reporting has really, really been bad. Phil had to pay back $931,000 in profits, which is a lot of money for me and you and most of you that are listening, and it's chump change to to Phil Mickelson, especially protecting all of the endorsements and everything else.
Yeah.
Now the question
did he?
Did the question? No, he wrote the check. The question is, did he really do anything that was wrong? And we'll never know the answer to that. He didn't admit to any wrongdoing. The SEC recognized with a new court case that it would be very, very difficult to have him prosecuted under insider trading, which would have been jail time.
Wow.
Plus another $931,000 civil penalty on top of it, or could have been jail time, I guess I should say. It's not always. But it was the attorney that I read about that covered the story said in 16 years of him covering the SEC findings, this one was unique. They'd never seen it happen before.
Why?
Why? Because the way that they treated Phil was kind of a way where Phil could say, okay, I'm going to give the $931,000 back because it was tainted, but I'm not going to admit to doing anything wrong. So the SEC didn't get to have the civil penalty, but they didn't get to say that they had this big court case against Phil Mickelson that lost. So the SEC saved face, got $931,000
and he
back.
Supposedly saved his endorsement
and
stuff.
He would have saved it, because that would have been if you hadn't have heard of this, if he was brought up on charges and could be going to jail, trust me, you would have heard about what happened with Phil Mickelson. So the deal is, it is very easy to get. I shouldn't say easy. Getting insider information happens when you know the right people.
Okay, question.
Whether you should or you shouldn't act on that is clear. You never should. We don't at the Financial Enhancement Group. If you called up and said, Joe, I want to buy Harley Davidson stock, we have a whole litany of questions that we're going to ask you about what made you want to buy that. Just like we do when we buy it for the whole models that we take care of. That way we can make sure that there's no tainted influence in terms of that investment. All right, Sherry's got her hand up.
My question is, define insider information.
It's when you have knowledge that is not publicly known or publicly available is probably a better way to put it.
Such as? Give me an example.
A drug being approved at Lilly before it's announced. Somebody doing a merger acquisition of another company. Salesforce bought ExactTarget last year, or maybe a couple of years ago now, but an announcement like that ahead of everybody else getting it. Now, the key thing here is deciding what is really insider information and what's not. I did a lecture in 1997 or 98 for a guy in Indianapolis. Well, the guy in Indianapolis came. He said, listen, I've got about $15 million of net worth. This is the internet tech, but it's all in stock. I can do nothing with it, but I want to give you a favor. And so he told me about a stock that was getting ready to do a big deal with AOL. And I'm like, whoa, that's insider trading. And he says, no, it's publicly released. There's just so many releases, nobody's read it. So I called, and sure enough, the secretary that answered the phone, that was my thing. I said, is this true? Yes, it is true. Has it been released? She goes, I have a copy of the release that went to the Associated Press already.
So,
I said, can you fax it to me? She did. And so we were able to act upon it. It worked out very, very well for the people that were involved. But everything was perfectly legal and kosher.
Yeah.
Every now and then, we've got people that are very high up in companies that tell us things, and we can't. There's nothing that we can do about it. You almost have to play dumb.
So excuse me, one more question. Is it wrong then for the people involved who know that's going to happen to make those kinds of...
Yes, they go to jail.
So like if I work for that company and I know that's about to happen, I'm still not allowed to...
No. If you're at that level, that's one of those things where they monitor all of your stocks. We have companies where we have to send them their portfolio.
Yeah.
Where they make sure that they're not making a market or buying or selling in various securities.
But they could, that they knew the announcement's going to happen at 8 a.m. on Monday morning. They could trade at 8:05.
Well, they could. But believe me, that stuff is watched. We made a trade for 100 shares of stock one time, 100 shares, which is nothing from our size,
right? And
got a call on
really
what instigated it.
Really,
and it's one of those things that is
they really watch it,
back before 2007. So
interesting.
Things do go on and change. In my opinion, Phil probably knew that he knew what he was doing may have not been totally correct. But it's a best case for everybody, and I will still watch him and his flop shot.
Well, yes, you will. I'm sure that's true.
He's always one of the fun ones to watch at the Masters. So.
Thanks for listening to Consider This with Big Joe Clark. Big Joe can be reached at 800-928-4001 or via email at bigjoe@yourlifeafterwork.com. The Financial Enhancement Group is located at 429 East 14th Street, Anderson, Indiana, 46016. Be sure to check out their website for more information at yourlifeafterwork.com. Have a great week, and don't forget to consider this.